What's happening, everybody? We got an exciting class today. Yes, we are going to go down a trip down memory lane when you first discovered your love of accounting. Remember that freshman or sophomore year when you took that intro to financial class, you looked around and said, who's better than me? Nobody. So we're going to review some basics of financial accounting. Now, I got to presume you've been out of school so long, you blacked out, you forgot all this stuff, and maybe you're in one of those states where they let you smoke those funky cigarettes and stuff that are messing up your brain. So I'm going to assume no prior knowledge. Sit back, relax. Let's do it. All right, accrual basis system of accounting, not cash basis. We do not record revenue or expenses when the cash is received or paid. We accrue for it. We got to record the revenue. We got to record the expense according to U.S. GAAP, obviously, and expenses with the matching principle. So basic, the word accrue, when you accrue for revenue or an expense, what does the word accrue mean? It simply means to record that revenue or an expense without an exchange of cash. We don't need an exchange of cash to book that revenue or expense, okay? We might have the cash, but we don't need it. We don't need to have received it or paid it. So when we accrue for revenue, we don't have the cash. We're booking the receivable, but we are going to book the sales revenue. And then you're going to follow the revenue recognition principle. For simplicity, it's got to be earned. And then accruing for an expense. I don't necessarily have to have paid the bill. I'm going to book the expense in the period incurred to generate that revenue, the matching principle. An airline buys a big fancy airplane. They spend hundreds of millions of dollars on that airplane. That's not an expense, that's an asset because they can reasonably believe that plane is going to generate revenue in the future, right? It has a probable future economic benefit. They'll then match that cost over the period in which that airplane flies passengers, hopefully safely, to their places, and then they'll book their expense straight line or whatever it may be. So when you accrue for an expense, you're booking the expense, but if there's no bill paid yet, you can't credit cash, so we know we credit some kind of payable, right? So the revenue when earned in simplicity, expenses in the period incurred according to the matching principle. Now, there are situations where cash exchanges hands before we could book the revenue or the expense. If you've been paid, but you haven't done the work yet, you've received the cash, but you haven't done the work yet, well, that's unearned or deferred revenue, right? So we'll debit our cash, but we got to credit a liability. We can't credit sales yet. And then there are situations like I explained where maybe you have an airplane that you've just purchased, or UPS or Federal Express buys a truck. They've already paid for it in cash. Well, that is not yet an expense, right? They've prepaid. So if it's a truck or something like that, they'll debit the truck or whatever. If you lock in, let's say, rent or insurance, you want to lock in a lower rate, so you prepay for an entire year or 2 years or 3 years, then you will debit your prepaid expense, you will credit your cash, right? So we don't have any revenue or expense yet, even though cash has exchanged hands. And then what we've already gone through, you could book revenue without having received it. You could book expenses without having paid it. Accrued revenue, we got a receivable match with that sale once it's earned. And with an accrued expense, we record the expense, but we haven't paid the bill yet. So that's when we'll credit, obviously, our payable, okay? So cash might be exchanged, may not be exchanged. Read carefully. Adjusting entries are to make sure the company is recording the revenues and expenses in the correct periods, not when the cash is received or paid, okay? That's the essence of the accrual basis system of accounting. Look, they'll tell you the pilot flew the airplane in December, but doesn't actually get paid until January 3rd. I don't care when that pilot gets paid, right? We will book that expense in the period the pilot flew the airplane to generate the revenue, right? The matching principle, so we'll book it when it's incurred, we'll debit the expense, but the pilot hadn't been paid yet, no worries, we'll credit salaries payable, all right? So we got to make sure the revenue and expenses are recorded in the correct periods, and that's the purpose of adjusting entries. So look, lots of different, really 4 scenarios. Scenario number 1, you've received cash, but you haven't done the work yet. You'll debit cash, credit, either unearned revenue, deferred revenue, maybe they'll call it a refundable deposit, depending upon the facts. But either way, you got the cash, but it's not yet earned. So we can't credit revenue. So we credit the unearned, deferred, refundable advance. Assets go up, liabilities go up, but there's no revenue yet, so no change to equity. Now, at the end of the year, we've got to make sure we note, well, how much of that unearned revenue, if any, has been earned this year. So then we'll do our adjusting entry to figure out how much of that unearned revenue is now earned. So once we've done that math, it'll be pretty simple. You'll reduce your unearned revenue, right? And you'll credit your revenue in its place. So look, Adjusting entries, notice there's always going to be one balance sheet account affected, one income statement account. Here we're reducing the liability and recording revenue in its place. So no change to assets, but the liability goes down, the equity goes up, balance sheet is still in balance. And notice how this adjusting entry does not affect cash. So folks, with adjusting entries like this, there's never going to be a debit or a credit to cash. That's always a wrong answer choice. Normally it's one income statement account, one balance sheet account when you're doing a true adjustment like this. The other situation is we've prepaid for rent or insurance or whatever. So we debit an asset, prepaid expense, but we've already paid in full, so we're going to credit cash. So now notice this. Total assets don't change, folks. They only change in form. Rather than having cash that goes down, we now have instead that prepaid rent or prepaid insurance, whatever it may be. So total assets don't change. They only change form. Liabilities don't change. Equity doesn't change. Then at year end, we got to figure out our adjusting entry. Well, how much of that asset, that rent or insurance, did we use this year? So normally this will be dictated over time or as you consume it, if it's some type of supplies, whatever. So we'll debit our expense, an income statement account. We'll record the expense for whatever we used or over time, credit the prepaid expense, reduce the balance sheet account. So again, a true adjusting entry affects one income statement account, one balance sheet account, does not affect cash. And notice our balance sheet is in balance because the prepaid, our prepaid expense, our balance sheet account went down, right? Not cash, but the prepaid. And then no change to liabilities, but your equity went down because remember, as you record expenses, that reduces your profit, which reduces your retained earnings, which in turn will reduce your equity. Okay, now with accrued revenues and expenses, a little bit different. With the accrued revenues and expenses, what does the word accrue mean? To record without an exchange of cash. So now I'm going to book the revenue, even though I haven't received it because I earned it, right? I met the revenue recognition rules. And then I'll book an expense, even though I haven't paid the bill yet, because I got to book it in the period incurred to generate the revenue, right? The matching principle. So let's accrue for revenue, right? We've earned it. We haven't been paid yet. You'll debit your accounts receivable. You'll credit your revenue. So in that case, assets go up, no change to liabilities, but your equity goes up because you booked that revenue. Now look, later on when you get paid, that's not a year-end adjusting entry, right? So when you collect it, that's when you'll book your cash, that goes up, and receivables go down. No change to total assets, only a change in form. Good, the receivable's supposed to turn over into cash, right? So eventually the cash will go up, receivable goes down, no change to total assets or liabilities or equity, only a change in form of the asset. But that's not a year-end adjusting entry, folks. That's not, because that's recorded when the cash is received, independent of year-end, right? So it has nothing to do with the matching principle or any of that stuff. We simply book the cash collected when we receive it. Okay, accruing for an expense. Even though we haven't paid the bill yet, we got to make sure we're recording expenses in the period incurred according to the matching principle. So we'll debit our expense, an income statement account. We'll credit our accrued liability, a balance sheet account. So if that hadn't been done yet at year end, that would be an adjusting entry. Even though you haven't paid the bill, you still got to make sure that expense gets recorded in the right period. So notice, with the debit to expense, that makes your profit go down, which makes your retained earnings go down. Eventually, that'll make your equity go down. And then how's our balance sheet in balance? Because you've got that accrued liability, salaries payable, accounts payable, whatever it is. You record the expense, but you haven't paid the bill yet, the liability goes up. So that is to make sure that expense gets recorded in the right period. Now, again, when you actually pay the bill, that's not a year-end adjusting entry. You have to wait until the cash is actually paid. So when you actually pay the bill, that is not a year-end adjusting entry. Upon payment, whenever that is, you'll obviously reduce your liability and reduce your cash. That payable turns over, right? Eventually payable should be paid, right? A true liability has got to be paid at some point in time. It's a probable future sacrifice. So the liability goes down and your cash goes down, no change to equity, all righty? Now, error corrections are a little bit different than those traditional adjusting entries to make sure we get the revenue and expense in the right period. Adjusting entries get us to where we should be at year end because prior to that, a mistake was made. So it's not like an adjusting entry where they did the right thing and then we have to, like, they booked the prepaid, right? So they debited the prepaid rent, credited the cash, and then at year end, we got to figure out how much of that rent or insurance we consumed. This is different. Somebody during the year screwed up, made a mistake, and now we got to fix it. So we've got to figure out what should be there at year end. So an adjusting entry is to make sure the financial statements are not incorrect. If they're incorrect, then they're not in accordance with U.S. GAAP, right? So we've got to make sure it's correct with respect to U.S. GAAP and the rules when things get recorded. So some rules for the traditional adjusting entries. You prepay for rent, right, or insurance. You credit your cash. Then at year end, you got to figure out how much of that rent or insurance you used. Or you have a situation where, you know what, you got to accrue for revenue. Make sure revenue that's been earned is properly recorded in that year. You're accruing for that revenue. Those are typical year-end adjustments, right? Fiscal year-end, before the preparation of the financial statements, make sure everything is recorded in the right period. And as we said, those traditional entries, adjusting entries, never involve the cash account. That's a common wrong answer choice. Traditional journal entries, for adjusting journal entries, you'll be affecting one income statement account, one balance sheet account. Now, that's a little bit different than an error correction. An error correction could really affect any account depending upon the specific error made. All right, so that could affect cash if you got cash and never recorded it, or you paid cash and never recorded it. I don't know. All right, so when you're correcting an error, little bit different rules, but the traditional year-end entries to get the revenue and expense in the right period, there's not going to be any adjustment to cash, okay? Now, let's take a look at typical year-end adjusting your journal entries. Make sure things are recorded in the right period. Just watch your dates. So here we go, December 1, year 1. We got $250,000 in cash for services to be performed. Stop right there. We haven't done the work yet. It's unearned. So step number 1 is, well, we got paid. So on December 1, the date we received the cash, we're going to debit cash, assets go up, but we're not crediting revenue yet. That's unearned, deferred, refundable advance, whatever, $250. Now, when are we going to earn this? This is going to be performed equally between December of year 1 and then January of year 2. So the $250,000 will be earned equally over 2 months. Take the $250 divided by 2 months, $125,000. So the true adjusting entry will be at December 31st. We've earned half of that $250. So we'll debit the liability, the unearned revenue. We'll credit the revenue. One income statement account, one balance sheet account. Assets don't change, but the unearned went down. What went up in its place? The earned. So notice, traditional adjusting journal entry like that, one income statement, one balance sheet, no change in cash. All right. The second traditional entry that you might see, in this case, we borrowed money, $2 million on what date? November 1st. Now, we borrowed the money at a rate of 3%, and we're going to pay that interest annually next November, but we're not cash basis. We can't record the interest expense when that interest is paid. No. We got to match it over the period in which we have the loan outstanding, which here is 12 months. So the first thing I want to do is figure out, well, what's my interest? $2 million loan times a 3% rate. That's the annual rate. So that's going to eventually be $60,000 of interest divided by 12 months. How much do we have to record monthly? $5,000 per month. When did we take out the loan? November 1st of year 1. So how many months worth of interest do we have to record? All of November, all of December, 2 months. 5,000 times 2 months, $10,000 of accrued interest. Even though we haven't paid the interest, it doesn't matter because we're accrual basis, not cash basis. Now, step number 1, we got the loan. So on November 1st, when we get the loan, we know we're going to debit cash, assets go up, credit your note payable, liabilities go up. Simple enough. Then at December 31st, the adjusting entry, we record 2 months of interest expense, debit interest expense, credit, not cash. We haven't paid the bill yet. We're accruing for this, so we credit interest payable. So again, note, a true adjusting entry like this, one income statement account, one balance sheet account, does not affect cash. We're just getting that expense in the right year. 10,000 of that belongs in year 1. Then the remaining 50,000 belongs in year 2. So with that adjusting entry, liabilities went up, equity went down because whenever you record an expense, that'll eventually make your profit go down, retained earnings go down. If we skip that, we just reduce our equity. All righty, not so bad. Come on, man, that's some fun stuff. Come on back, let's do another one. welcome back. More exciting stuff. Adjusting journal entries, this time part 2. Let's see if it's better than part 1. Let's see if the sequel can match the excitement of the original. All righty, so again, adjusting journal entries, the typical adjusting entries to just make sure the revenue and expense gets recorded in the right period. General rule, the adjusting entry will affect one income statement account, one balance sheet account, and those traditional adjusting entries to get things in the right period, you're not going to be touching cash. Okay, in this example, we're going to have errors, all right? So errors are a whole different story because you got to figure out what was done and how do we get from where what was done to where things should be. It's not all that difficult, but these are a little bit non-traditional because somebody screwed up. All right, as of right now, before any fixing of any errors, this Titan company has earnings before tax of $8,000. So we got to fix that because they made mistakes. We got to fire this bookkeeper. All right, if necessary, record an adjustment to the pre-tax income to fix the errors. And we want to make sure we're in accordance with US GAAP, accrual basis system of accounting. Now, again, just a friendly reminder, just in case you're in one of those states like Colorado or New York or California, I took my kids to a Knicks game, Madison Square Garden. Man, by the time I got into that the time I got into the Garden, I had this strange craving for like potato chips and pizza. I don't even know what was going on. But just in case something is affecting your memory. All right, with an expense, if you want to increase an expense, you debit it. You want to get rid of an expense because it's overstated, you have to credit the expense. With revenue, if you want to record revenue, increase it, you do that with a credit. If somebody screwed up and booked revenue when they should not have, how do we therefore reduce revenue? Well, we decrease it with the debit. So here we go. Now we're going to adjust to correct errors. Now, the current year is actually year 2. All righty, so this is what happened in year 2. Here's the actual entry. So for number 1, the company bought a 3-year, $300 insurance policy on January 1st, year 2. Watch those dates. But they screwed up. They expensed it all immediately. So what was done? Well, the actual entry was they must have debited expense, right? So in this case, insurance expense, credited cash, $300. I got no problem with the credit to cash. We have a problem with them booking that as an expense. Now, look, at year end, what should happen? Well, look, this is for 3 years worth of insurance. So take your $300, divide it by 3 years. The expense should only be $100 for that year. So we've got to reduce the expense by how much? $200. They recorded it by $300. We have to get it down so that the expense this year is only $100. So what are we going to have to do to reduce an expense? We do that with a credit. So we're going to credit insurance expense $200. Now, how are we going to make this work? What are we going to put in its place? What should have been there originally? Oh, yeah, the prepaid, right? The PPD. Yeah, you know me, not to be confused with OBD. PPD, you ready? 300 minus 100. What should be in the prepaid expense account at the end of year 1? $200. All right, so to make your journal entry balance, we have to put in what was never recorded, the prepaid. Number 2, $2,000 of credit sales made during the year were not recorded in the ledger. Well, because they didn't get any cash, so nobody recorded any revenue. They should have accrued for it, so nothing was done. So what do we have to do? Well, we got to record the $2,000 of revenue that we earned. So we got to get revenue up by $2,000. How do we increase revenue? With a credit. So we know we're going to credit sales for $2,000. Now we're owed the money. So obviously, what are we going to debit to make our journal entry balance? Well, when you're owed money, you debit accounts receivable. Not so bad. Let's try another one. Number 3, cash totaling $3,000 that was received in advance from customers. Well, they screwed up and booked that as revenue. This year, only 30% of that should be revenue. So step number 1, what did they do? They debited cash. I got no problem with that because they got cash, $3,000, but they credited revenue. All right, we got to reduce revenue because we hadn't earned all $3,000. We only earned what? What's 30% of $3,000? Only $900 was earned. How do we get from $3,000 down to $900? We got to reduce revenue by $2,100. How do we reduce revenue? Well, we know we got to debit revenue for $2,100. Now, what did they never record that they should have recorded when they got the cash that was unearned? Oh, yeah, they got to credit unearned revenue, refundable advance, deferred revenue, whatever they give you. All right, so reduce the revenue with the debit, credit the unearned revenue for $2,100. Number 4, the accountant discovered a $450 utility bill covering the month of December has not been entered in accounts payable. Why? Because they hadn't paid the bill yet. They didn't record anything. Well, they should have, right? So we've got to record a $450 expense for the month of December. All righty. So we got to get expenses up by $450. So what are we going to debit? We got to debit the expense, right? Increase the expense by $450. Now we haven't paid the bill yet, but that's irrelevant. We record expenses in the period incurred, whether we paid the bill or not. So if we haven't paid the bill yet, what are we going to credit? Accounts payable. Remember, when in doubt, we don't touch cash. Okay, we don't touch cash when we do the adjusting journal entry. All right. Now, unless they didn't record the cash, then you might have to. Okay, but in this case, they never paid any cash, so they hadn't recorded the bill yet, right? So you can't credit cash, you got to credit the payable. Number 5, $4,000 of rent was prepaid. That's an asset. January 1, year 1, covering 4 years. What did they do? Well, let's see. Well, but wait a second, check this out. That happened back in year 1. So in year 1, let's say they did the right thing. In year 1, debit the prepaid rent $4,000 because we're in year 2. So we got to assume by the time we got to year 1 was eventually done correctly. So debit prepaid rent $4,000, credit cash $4,000. And then whatever adjusting entry at the end of year 1 to record 1 year's, we're not doing year 1 fixing, only year 2. So we got to assume year 1 was fixed. We're year 2. They never recorded anything in year 2 for the use of that rent over time. Well, they prepaid for 4 years worth of rent. 4,000 divided by 4 years, they've got to record rent expense of $1,000 per year. They hadn't done that in year 2, but let's assume they did the right thing at year 1 and did the adjusting entry at the end of year 1. So for year 2, we've got to record another $1,000 of rent expense. All right, so expenses have to go up by $1,000. That will reduce your earnings before tax. So I got to debit the rent expense, $1,000, and we're using up the prepaid rent. So prepaid goes down by $1,000. Now they might ask you, hey, at the end of year 2, what would be the balance in the prepaid account? Well, it started with $4,000. We used $1,000 in year 1, $1,000 in year 2. Confidence building. Pray for this on the exam, right? What would be the balance in the prepaid rent account? $2,000. Okay, let's try another one. Number 6, the direct write-off method, a non-GAAP method, was to write off a $650 bad debt in year 2, even though the company uses correctly the allowance method. Now, the direct write-off method is something you use for tax. You're not supposed to be using that under U.S. GAAP. So if they incorrectly use the direct write-off method, let's say this were tax, then what journal entry did they do? Well, they debited bad debt expense for $650, credited the accounts receivable for $650. That's the problem. That's the journal entry they did to write off that accounts receivable under the direct write-off method. Now, since they're using the allowance method, you got to know, well, what journal entry should they have done to write off that accounts receivable? Remember, the bad debt expense under the accrual basis gets recorded in the period when you recorded the revenue matching principle. So we should not be debiting bad debt expense again. The bad debt expense should be recorded in the period you booked that credit receivable to match the expense with the revenue. You either got to use a percentage of credit sales or receivables, whatever. But bottom line is, when you do this correctly, the journal entry should have been a debit to the allowance account for $650, a credit to the accounts receivable. So the credit to the accounts receivable, I got no problem with. So we got to get rid of the debit to the bad debt expense and replace that with a debit to the allowance account. So what's the correcting entry? Debit the allowance account for $650 and get rid of the bad debt expense that was incorrectly recorded. How do we get rid of that? With a credit to bad debt expense for $650. So a little bit more challenging. You got to remember your rules for booking, how you account for receivables, okay, percentage of sales, whatever it may be. Okay, number 7. The company bought $1,300 of raw materials at year end, which was shipped FOB shipping point. Now, this is one of those business law things as well they're mixing in. Technically, when you order goods, materials, whatever it is, if it's FOB shipping point, even though the truck has not yet arrived at your facility, at your warehouse, at your loading dock, that's irrelevant. Once the goods get in the truck, then that's your inventory. Well, let's see what they did. The goods were not included in their inventory. Well, they made a mistake. No journal entry was done at all. What should they have done? Well, once the goods get in the truck, Now the adjusting entry, I got to record that raw material, so debit the raw material, and I haven't paid for it yet, so I got to credit my accounts payable $1,300. Okay, so you'll debit your raw material, you'll credit your accounts payable. Now notice, this correcting entry affected two balance sheet accounts. It did not affect any income statement account because raw materials, obviously an asset, accounts payable, a liability. So again, as a general rule, you would expect your adjusting journal entries to affect one income statement account, one balance sheet account, and usually you're not touching cash unless they incorrectly did something to cash during the year, which is not the case here. So in this case, that correcting entry, they never recorded an asset and they did not record the liability. So obviously we got to record the asset and the liability, okay? Now, last one. I know this upsets you. The company purchased available for sale securities for $1,500 during year 2. Okay. The fair value at year end was $2,000, but no adjustment to fair value was recorded in the ledger. So you got to know something about marketable securities. When you buy securities, okay, whether it's, we'll make this debt securities, okay? With debt securities, that available for sale, that's fair value. You got to market to market value if it's classified as available for sale, or what they call now fair value through OCI. So you buy these debt securities, and then if you decide to classify it as fair value through OCI, or what they used to call available for sale, you've got a market to market value at year end. They never did that. Okay, so they did no entry at all. What they should have done, well, let's see, good news or bad news? Well, that security went from $1,500, oh, good, to $2,000. So we got to increase the asset. The asset's got to go up by $500. And then this is an unrealized gain. So it goes direct to equity. Under the accounting, if you haven't reviewed this yet, when you account for available for sale, or what we call fair value through OCI, if you haven't sold it yet, but it's changed in value, that's called an unrealized. In this case, it could be a gain or loss. Here it's a gain. So it goes direct to equity. This gain is not yet on the income statement until you actually sell it. So the asset account has to go up, and this goes direct to equity. So the equity account goes up, but it's not yet on the income statement. So we debit the asset for the unrealized gain. It goes up by $500. Credit equity. This is actually direct to equity. And again, one of those situations where two balance sheet accounts are affected. Even though we have a gain, this is not yet on the income statement because the fair value through OCI, again, is one of those direct to equity adjustments, all right? So when you do all your adjusting, as you kept track, did I increase revenue, decrease revenue, increase in expense, decrease in expense? When you net it all out, the adjusted year 2 earnings before tax. Now notice, I set it up here for you. The first column is all the adjustments to an income statement account. The second column is all the adjustments to the asset account. The third column is any adjustments to liabilities or equity, balance sheet accounts, okay? But when you do all your netting out of all those adjustments, obviously there's your adjusted earnings before tax year 2, $7,300. So obviously these 8 stuck together make for a nice task-based simulation, right? Along a problem. Any one of these facts, independent of the others, makes for a great multiple choice, all righty? So if you missed any of my explanation, we wanted to make sure it was printed out for you nice and pretty. So here is the recap of all 8 adjusting entries. So the next 5 slides are just simply a regurgitation of what I went through, nice and neat, which you can go through on your own. All right, you got to understand what was done, what should have been done, how do we get there to fix it. But notice, those adjusting journal entries in a multiple choice, when in doubt, one income statement, one balance sheet, usually, right? And usually, unless there's an error where somebody didn't record cash when they should have, whether it was received or paid, normally adjusting journal entries, you don't touch cash. Unless there's an error correction, we got cash, somebody stole it, didn't record it, or cash was paid and for some reason somebody didn't record it. All righty, that's all I got for the adjusting journal entries. I know you love this stuff. So I'm going to let you stop here. If you want to try some multiple choice on that topic, go right ahead. See you back in a little bit.